This video is brought to you by TogetherBudget.com. Buy and hold investing involves purchasing a diversified portfolio of stocks or other assets and holding on to them for the long term, regardless of market fluctuations. This strategy focuses on avoiding frequent buying and selling, which can lead to higher fees and taxes. The key principles of buy and hold investing include dollar cost averaging, which involves investing a fixed amount of money at regular intervals to reduce the impact of market volatility. It also emphasizes the importance of low costs and taxes by minimizing turnover. Buy and hold investing offers several benefits, including reduced transaction costs, lower stress levels, and a more tax-efficient approach. By avoiding frequent buying and selling, investors can also avoid the risks associated with market timing. One common misconception about buy and hold investing is that it ignores market fluctuations or means being passive in one's investments. In reality, this strategy involves active management through regular portfolio rebalancing to ensure it remains aligned with the investor's goals. To implement a successful buy and hold strategy, it's essential to diversify your portfolio by spreading investments across various asset classes. This includes stocks, bonds, real estate, and other securities. By doing so, you can reduce reliance on any single market or industry, thereby minimizing potential losses. One of the most critical aspects of a buy and hold strategy is adopting a long-term perspective. This means holding on to investments for extended periods, often 5 years or more, rather than making impulsive decisions based on short-term market volatility. By doing so, you can ride out fluctuations and give your investments time to grow. A buy and hold strategy requires a great deal of patience, as it's unlikely to generate significant returns overnight. Instead, focus on steady and consistent growth over time, allowing your investments to compound and mature at their own pace. This approach may not be the most exciting, but it can lead to remarkable long-term results. In the face of market uncertainty, a buy and hold strategy can provide a sense of security. By having a well-researched and thoroughly thought-out investment plan in place, you'll be better equipped to handle unexpected events and make informed decisions when necessary. This approach helps ensure that your investments remain aligned with your goals and risk tolerance. In a buy and hold investing strategy, risk management is crucial to minimize losses through asset allocation and dollar cost averaging. This involves spreading investments across various asset classes to reduce exposure to any one market's volatility. Asset allocation is a key component of risk management, where investors allocate their assets to different classes such as stocks, bonds, and cash. This strategy helps distribute risk across various asset classes. Dollar cost averaging is another essential tool in buy and hold investing, which involves investing a fixed amount of money at regular intervals, regardless of the market's performance. This helps investors smooth out market fluctuations and avoid timing risks. Effective risk management in buy and hold investing also involves maintaining a long-term focus. This mindset enables investors to ride out short-term market fluctuations and benefit from the compounding effect over time. Critics argue that buy and hold's failure to adjust for market volatility can lead to significant losses, especially during periods of high inflation or economic downturns. This approach assumes that long-term averages will always prevail, which is not necessarily the case. Another criticism is that buy and hold's static nature can lead to poor asset allocation, as it doesn't adapt to changes in market conditions or individual investor goals. This can result in a mismatch between investment portfolio and investor objectives. The buy and hold approach has also been criticized for its disregard for the impact of human emotions on investment decisions. It assumes that investors will remain rational and disciplined, which is not always the case in practice. Finally, some critics argue that buy and hold's reliance on passive index funds can lead to a lack of transparency and accountability in investment management. This approach may not provide the same level of scrutiny as active management. Buy and hold investors have successfully applied this strategy to various asset classes, such as real estate, commodities, and even cryptocurrencies. For instance, The Vanguard 500 Index Fund has consistently outperformed actively managed funds over the long term. On the other hand, buy and hold investors have also experienced significant losses in certain asset classes. The 2008 financial crisis saw many investors holding onto mortgage-backed securities that ultimately defaulted, leading to substantial losses. Research has shown that buy and hold investors tend to perform better than those who actively try to time the market. A study by Fidelity found that 90% of investors who followed a buy and hold strategy outperformed those who tried to time the market. To illustrate the benefits of buy and hold investing, consider the case of Warren Buffett. Despite experiencing significant losses in 2008, Buffett's long-term focus on value investing has led to impressive returns over his career. When compared to active management, buy and hold investing often outperforms by minimizing trading costs and maximizing long-term returns. It eliminates the need for constant market timing and portfolio rebalancing. To evaluate the effectiveness of buy and hold investing, various performance metrics are used. These include Sharpe ratio, Sortino ratio, and alpha. A higher value in these metrics indicates better risk-adjusted returns. The costs associated with buy and hold investing are generally lower compared to active management. This is because there's less need for constant research, analysis, and trading activities. A low-cost index fund or ETF can provide broad market exposure. In various market conditions, buy and hold investing demonstrates its resilience. During periods of high volatility or market downturns, it can help investors stay committed to their long-term goals and avoid making impulsive decisions.